Good afternoon, and welcome to this week's edition of Academic Markets Insights. This week, we are going to be doing something a little bit different, but equally as good, maybe even a little bit better. We are going to be focusing on the VIX and the impact on the election. And Dr. Rhoads, aka Dr. VIX, will be taking us through this. So this will be VIX and the election. I'm excited about this because this plays into this idea of how do the markets really feel about the election? How does that get priced into our assets? And what should we be thinking about when we're thinking about approaching trading throughout this next time period? And let's face it, the VIX is just fun, right? It's just a fun calculation that really then measures what the market is thinking about what's happening around, right? I like to talk about the implied volatility. I pick up my brother Joe all the time because my brother Joe likes to wear shorts all year round. So he is a poor indicator of what the weather really is. But if you're to look outside, right? So that's what we can start to think about with the VIX is what is the market thinking? They could be wrong. So Dr. Rhoads, Dr. VIX will be walking us through this. And again, I want to make this plug more than once today. If you like this content, please hit subscribe, please hit like, yay. And if you're interested, please give us suggestions for topics that you'd like. We are very open. Again, the idea is this is what we would be talking about in our classroom. And a lot of what we talk about in our classroom comes from what our students ask us. So go ahead, ask what you'd like to hear. And with that, let's start the presentation, Dr. Vix.
So, as the title says, VIX and the election. What am I going to do? What I'm going to do here? I'm going to give everybody a brief VIX description, and then I'm going to talk about the term structure, which is the VIX futures contracts relative to the VIX index. And then just demonstrate how we've got some interesting stuff going on with respect to how the market is anticipating what the reaction is going to be around the election. It's pretty interesting now that we have daily options. We're going to be able to break down exactly where people are expecting the volatility in the overall markets. So VIX, I think everybody's familiar with it having that inverse relationship with the S&P 500. It is a consistent measure of 30-day expected volatility, and we use S&P 500 index option contracts to calculate that measure. It's a weighted average that uses two different expiring series, and it's like a time weighting so that it hits right at that 30-day window. In fact, the time component is updated every minute throughout the trading day. So every minute, one series of options is not feeding into the calculation as much as it was earlier. And the farther out series is starting to become more and more of the calculation. Then when it hits right at 30 days, that series starts to come off as well. So sometimes you do take into account which expirations we're taking a look at. And then I did mention that we've got that that moniker, the fear index. Stephen Sears over at Barron's came up with fear index a couple of decades ago due to the inverse relationship between VIX and the S&P 500. I actually think that probably was around the 2008 time, if not maybe before that. So I see I have a question. Dr. A, what is your question?
I thought that the VIX had used a different series of options for their calculation. Am I correct or incorrect? I thought it was based around
No. No,
Okay.
you're not incorrect. What it uses now, the methodology has, and I'm going to use the SIBO term for this. The methodology has been enhanced over time. And originally, way back, it was based on S&P 100 options, on OEX options. Then it switched over to the S&P 500. Now, and when it switched to the S&P 500, it was using the standard third Friday options that expired just before 30 days and just after 30 days. So you would have like a 15-day and a 45-day option, and the average of that, good math there, Russell, is 30 days. What's changed is now you have options just before and just after the 30-day window. So you never have options that have less than 23 days or more than 37 days. When a new one comes into the calculation, it has 37 days. And then when it's 23 days to expiration, it falls out of the calculation. Now, this is one of the best leading questions ever, because this is the first election where we've had daily options, and we can see a couple of things going on with the daily options. So right here, there we are. The daily, this is VIX and the S&P 500 every trading day in October, and we're sitting here on October 23rd, middle of the day. So I included those middle of the day numbers, and what we're looking at is the close for the S&P 500 and VIX, and that big dot is when November 8th options had their heaviest weighting in the VIX calculation. And why do we care about November 8th options? November 8th options are the first the first Friday expiration that would go into the VIX calculation after the election. Now, as we got past the 9th, now I know that the S&P 500 is going up and VIX is working its way down, like you would expect. But the S&P 500, as I sit here, is about where it closed on October 9th. And it hasn't rallied too much. It really hasn't done much at all in the last couple of weeks. Everybody really is in a wait and see period right now. But as the options that feed into the VIX calculation move farther out on the calendar and farther past election day, the potential volatility around the election is not going to have nearly as much of an influence on those options as it does on November 8th, or even better, Wednesday, November 6th, or Thursday, November 7th. We'll look at those in a minute as well and see what they're pricing in. But this is unique to the current VIX calculation. It didn't make too much of a difference, but there were a couple of, when the November 6th option started getting into the the November 8th option started getting into the calculation, you could just feel a tailwind with respect to VIX. It has a nice rally from 5,700 to almost 5,800 over a 2-day period, and VIX drops from from around 22 to about 21. So not much of a drop there at all. In fact, that black dot there was an all-time high for the S&P 500. We've had almost 50 of them this year, and VIX over 20 when you're looking at an all-time high in the S&P 500. That's a bit of an anomaly as well. So it's not a positive or a negative. It's just a factor that you would need to take into account with VIX, that it's using, and all other volatility indices use the standard third Friday. So you saw VIX get a tailwind when VXN, which is the NASDAQ 100 one, and RVX, which is the Russell 2000 one, neither of those were behaving the same way as VIX was. In fact, as I sit here, I kind of wish I had a chart of all three of them so I could demonstrate that. Yes, Dr. A.
So I'm curious, I'd like to explore the idea of having a high VIX and a high S&P 500. So you were saying that traditionally that they're usually inverse, so you're not going to see both of those highs. What do you think that means that the market is trying to tell us?
Well, in this case, normally when VIX and the S&P 500 are trending in the same direction, we consider that kind of like a canary in the coal mine with respect to the markets. If you remember back in 2018, we had that Volmageddon situation in February. I was still working at SIBO at the time, and for the first 4 or 5 weeks in 2018, the S&P 500 and VIX moved up in sync with each other, and which I should always use this as some kind of indicator. But when I worked at SIBO, I would help field a lot of reporter calls about, the Wall Street Journal would call up, what's wrong with VIX? Why is it not moving opposite of the S&P 500? Sometimes it's because you've got You have folks buying protection, and typically what drives VIX higher is purchases of put options. More put options trade on the S&P 500 than call options each day. And if you're seeing buyers of put options while the market is working its way higher, then that's an indication that maybe pros aren't necessarily buying into it. Yep.
So would you say then the VIX is almost mirroring that volatility smirk a little bit more? So if we were to start modeling the smirk, we would see a more dramatic smirk as opposed to more of a flatline smirk.
Absolutely. And in fact, I was talking to a French derivatives trader. We all know at least one. Paris is like Paris is probably the center of derivatives trading in Europe, in all seriousness. I was talking to a guy today about this very topic, and we were just kicking around that VIX is not doing a whole lot leading up to the election, and you're going to have to repeat your question. I got sidetracked there. Well,
Sorry about that.
that,
But we're talking about the VIX mirroring more of the
oh,
change
the
of
smirk, yeah, the skew. So I knew it had to do with the skew. What he was noting is that you can measure skew in a lot of different ways, but we're typically referring to the implied volatility of puts versus the implied volatility of calls. And the implied volatility of puts relative to out of the money calls in the SPX complex right now, it's up around the 90th percentile.
okay.
So and so those out of the money puts are being bid up. Traders are putting on some sort of protection in case we have a less than smooth transition after the election, which can incorporate an awful lot of things. So yeah, he was. I apologize on that sidetrack. We all know that still happens. That happens to me every once in a while. But yeah, he was just talking about how the big driver, and the feeling is if we don't get the sell off after, if we don't get any sort of sell off, if the election goes smoothly, that VIX will come in because the demand for those out of the money puts will not go away.
Do you think that this is in reaction to last year's or not last year's, last 4 years ago, or two
Actually,
elections?
it's actually 8 years ago.
8 years. Okay, thank you.
That's the election
Mhm,
that everything in the world, and this is a joke,
mhm.
everything in the world is Donald Trump's fault. So,
Right. Mhm.
but
Oh,
and we're going to take a look at those curves in just a minute,
okay.
so you can see what the volatility term structure used to look like before elections and what it looks like now, because it's completely, the 2016 election completely changed, just completely changed how the market anticipates what's going to happen post election. Now the term structure, and that the term structure, if you look at VIX, if you don't trade VIX at all, but if you have it on your screen next to the S&P 500, you really should have the front month future next to it as well, because the front month future, or all the futures, don't have the kind of fair value relationship that you would find in an equity index market. So
Mhm.
sometimes the VIX futures will trade at a discount. Sometimes they will trade at a premium to the spot index. They typically the futures are at a premium, and we refer to that being in contango. When the future pricing is at a discount to VIX, you can take that, and I'm going to ask you a question. You can take that as a signal that the market thinks VIX is going to go lower in the near term. Typically, what does it take for VIX to go down?
The market to rally?
Exactly. So that's
Good.
just one of those things that you can kind of take into account. If we get a spike in VIX, look at that front month future. If the front month future, if we get a move in VIX to here, and the front month future is down here, well, it's anticipating that the index is going to come back down. If the future goes up in line with it, that's that. Maybe you need to, as one portfolio manager I used to work with, like to say, keep your powder dry and be prepared to buy at lower levels.
Right.
So and that's why I say have the front month future on there. Really, I like to have the front 2 month futures on there. So here are our election year term structures, and I used the October expiration date for the last four. Now we have okay data for 2008, Does anybody in the crowd remember what was happening in the fall of 2008? VIX
Some
was
of
up
us
around
might.
VIX was up
Yeah,
around 40 or so. So I just feel like it's not worthwhile putting that curve on here because the influence on that was very different. It had nothing to do with the election.
right.
Right now, it has to do with the election. Um, what were you gonna say?
I was gonna say, I remember the fateful day in September. I was on a cruise with my mom in the Bahamas, and my sister called me and panicked and said, "The world is falling apart. Lehman Brothers has collapsed. What are we going to do?" And again, to your point, it was too close to the election. It's going to
Yeah,
have so much of
yeah,
an impact on that.
yeah. It was inverted and it was up around 40 or so, which if I put it on here, it would the rest of the curves would look flat. So no 2008, but 2008, I don't think the data makes any sense either. Do note, look at 2012 and 2016.
Hmm.
That's normal. That you would if I said, you know, uh, if I gave a quiz and I said and the 2012 curve was answer A and 2016 was answer B, and I said and answer C is none of the above. If the test question was which of the following curves was 2.5 weeks before before a presidential election, most people that have only that a lot of people have only been around for a decade or so in our business. They may not even remember 2012 or 2016. All they've seen is 2020 with elevated and 2024, where we do have November at a slight discount to spot, which is an indication right now that the way the volatility markets have been acting, it feels like the market's not terribly concerned about a less than smooth transition. That's how I like to refer to all the different kind of goofy things that might happen after the election.
And
Lawsuits, burning down buildings, shaking your fist at clouds. That's what I do. Those types of things.
um,
So this is the one, and it's not like I just throw these things up in front of Dr. A. We talk about them ahead of time. And this is the one that when she saw it, she went, wow. And what this is the at the money implied volatility. We have daily options going out several days, I mean, several weeks in the S&P 500 now. And this is the at the money implied volatility for just the SPX straddle midday on October 23rd. And notice what happens between November 5th and November 6th. Pops right up. And that's a 3-point difference. It was only about 2 points a couple of weeks, about a week ago. So a 3-point difference between November 5th and November 6th. So they are bracing. So one of the things that traders will do is they will take implied volatility and they'll divide it by 16 and say that's what kind of move the market is anticipating. The at the money straddle right now is only pricing in about a little over a 1% move the day after the election. That's not huge. It'll be interesting to see if that widens, if that number keeps going up as we get closer and closer to the election. But as every time that I've checked on it lately, that November 6th at the money implied vol has been around 16 and a half. So, yes, ma'am.
so what do we also think about the fact that it doesn't drop quickly? We continue at that elevated volatility for quite some time afterwards. Does that get into the idea that we're still concerned about that transition, or does that just indicate that we don't really know what's going to happen? So we're a little more aware and conscientious and perhaps putting on more of those puts for downside protection.
No, there's most definitely downside protection being purchased in that week. And November 6th, that's a Wednesday. November 7th, normally FOMC meetings are or announcements are on Wednesdays, but this is a 2-day meeting. Maybe they'll have a lot to discuss with respect to the election. Who knows? But November 7th is an FOMC announcement. No, that's why we've got that bump up to 17 there, and then it starts to trail off. If this were an earnings, if this were a company that was reporting earnings Now we only have weekly options for those, but it would look more like a spike up and then a spike down.
Okay.
Because an earnings announcement, we're going to get all the information, the market's going to digest it, we're going to move on in life.
Right.
And we see the same thing with economic numbers. Like I could show you the implied vol, the at the money implied vol when CPI is coming out one week and how it's a little bit higher than the other days, but it comes down the next day because it's not a multi-day reaction. The election could be a multi-week thing. I've forgotten how long it took for in 2000 for them to decide who actually won Florida. I feel like I know it was after mid-November.
So I felt like
I
it
was on
closer
I
to
was
a
on
month.
a well, I was
Mhm.
on a date. I was on a date with my wife. We met in 2000, and I was on a date with her in early December when they declared Gore the winner.
Okay. Yeah, I
That's how
thought
I know the timing of it. And I met her 2 weeks after the election, so it did take at least a couple of weeks. I feel
mhm.
like that was after Thanksgiving, though. I
I
don't know.
feel like it was.
It
I
took a
was,
while.
yeah, that was the first election I ever voted in. First
Oh,
presidential election that I ever voted in. I was a
I'm doing
senior.
math. Yeah.
Yeah, I was a senior in college.
Okay. So, well, I have two children. It's the first time they've ever voted. In
It's
fact,
exciting.
one of them did it today. So there.
Good for her.
So yes, this implied volatility, the way it's acting right here is if it really is looking like that there's an expectation that we're not gonna that there's gonna be a whole lot of, I'm using old man terms today, rigmarole afterwards and arguing and people yelling at cameras and lawyers making a lot of money, etc.
They do that.
Unfortunately after the election. But on the other side of it, uh, we we've seen instances where the risk around the election, the pricing of the risk around the election came down and then went back up.
Mm.
And it came down after the first debate with Biden. The
Okay.
market really, and it's not, again, we have to be so careful when you even talk about elections these days. I'm not endorsing anybody. I'm just saying what happened. And what happened was the October VIX future came down to almost priced in line with the October one came down, priced almost in line with the November one. And then they spread back out when Kamala got into the race, and it looked like she was going to give him a run for his money. The betting markets now have Trump at a 60% chance of winning, and volatility has come down some. It's not where it was before, but it's not like, I mean, you see the November future at a discount to VIX. That means the people trading the November future believe that it's going to go down between now and, or that it will probably going to go down between now and expiration. If they were worried, if they were braced for some sort of volatility event in the first week of November, the term structure would look a lot different.
Right. And I think a lot of traders really do believe in the collective wisdom. So
Yep,
you could be,
I do.
there's obviously the idea that you're going to be seeking alpha and looking to be that anomaly. But a lot of time, traders look to what is the collective wisdom of the group doing, and the fact that there are markets out there that are saying that uh, Mr. Trump has the advantage in the polls or a higher probability, and people are putting money out there. I think that's a potential indication. Again, I'm not endorsing, just reflecting what the markets are
Telling you
saying.
it's just like it's just like saying the derivative markets are pointing to the Fed funds rate to be at 3.3% a year from now. Just
Right,
telling you what the number says. And
right.
the betting market at such a high level for Trump is just kind of surprising when the polls seem to be neck and neck.
And it
And I mean, somebody bought basically spent $30 million on a binary option saying that he was going to win.
And usually, because I think about this in the terms of if you are shorting a stock, right?
Mhm.
Those people usually spend a little more time investigating. And if you're putting $30 million behind a trade,
You
you're
know some.
hopefully spending the time really analyzing. I hope.
So, oh well. So we will see how this thing plays out. We'll see if volatility crushes like we would expect it to. But that's the one that also seems to be a consensus right now. Everybody's in a wait and see as of late October, but there's a very strong feeling that VIX is that market volatility is gonna come down after the election, regardless of who wins. The panel of experts that I'm doing something with tomorrow that discuss this, the feeling is that if Kamala Harris wins, that it might be a little bit more bearish for stocks over a short term, but just be more of a long-term buying opportunity than anything else. So that's the feedback I've gotten from pros all around the world. We'll see.
And that's great information for
Yeah.
us. Well,
Cool.
thank you so much, Dr. Vix. And thank you everybody for joining us. Again, I told you I was going to make this plug more than once today. If you like this, please subscribe and click like. Also, we are very interested in hearing what you are interested in. We are happy to discuss anything in the markets. We will stick to finance related topics only, but really the financial markets are what we'd like to discuss. If you want to talk about the WACC or weighted average cost of capital, we'll come up with some way to integrate that with the financial markets. So really, whatever you're interested in. If you're in my class, my graduate class this week, if you need to talk about some specific topics that might be on the exam, let us know. We can work it in. Okay, with that, we thank you again so much for joining us. Thank you.